worry about it. Yes, you are here, Chris. Well done. I don't know what happened. You weren't in the other channel. Anyway, first world problems with the registrations. Everyone can catch the replay, no doubts. Hello, hello. We are live and in the trenches. We finally got the tech snafu fixed. And there's at least one person here. Hello, Mum. Nonetheless, we're now live on Zoom. So let's do it. So one or two of you may have heard this before. Those that haven't, we're going to be looking at never getting stopped out again. And this is in relation to stock market swing trading, etc. So if you are looking for information about the markets, then you are in the right place. If you're looking to capitalize from daily, weekly, monthly swings of the markets, then great, stick around. If you're looking for underwater basket weaving or snorkelers, kickboxing, then maybe you're in the wrong place. Did that used to be a thing? I remember way back in the 90s, late 90s, we used to talk about business in the loosest context because I was still in my teens, or what I thought was business. But we used to joke around saying if underwater kickboxing was a thing, and it turns out that it is a thing. Am I sharing my screen? Let me share my screen. Not sharing my screen. Bear with me. There we go. So let's do that. Yes, screen should be sharing. Perfect. So we used to talk about underwater kickboxing as a joke, and then this thing that you may have heard called the internet came about, and suddenly underwater kickboxing was a thing. Underwater basket weaving became a thing. The fusion of snorkeling or scuba diving with on-land activities became a viable thing, and now people all around the world have found their weird-ass behavior because of the internet. Anyway, that's all why we're here, and we found our collective weird shit when it comes to the stock market. So the visuals are good. They're all going. That's great. So now that the slides are going, I've got my pretty little slide up and running. So let's do it. Stop it. Never get stopped out ever again. Now, just to underscore the brief talking point for today, it doesn't mean that you won't ever have not have losses. You will have losses. They're inevitable. As with any business, that losses are a part of any business. But what we can do is never worry about, did I place my stop loss at the right points? Was it at the right place? Because we've all been there. We've all had the experience of you put a stop loss, or you place a trade, you place your stop loss in the market, it gets dinged, and then you watch the trade that you've just been stopped out of do the thing that you expected it to do in the first place. And inevitably, it's the one that went to targets without any pain or fuss or muss. But you're on the sidelines watching it be stopped out. So we've all had those experiences. And so we can avoid those quite completely. And we've got some great examples of this, real examples in some of the trades that we've had in the last few weeks that we've been talking about here on these open sessions. So that's going to be the talking point for today's session. Never get stopped out again. Again, let's get started. Now we've got the slides going. So if you are looking to profit from daily, weekly, monthly swings, you're in the right place. We've had the whimsical story of the underwater basket weaving. If that's what you're looking for, then you're in the wrong place. But if you are looking for the markets, then we're in the right place. Now, I'm a huge advocate of trading should be simple. I was talking to Chris about this not 5 minutes ago, and you've got to make it simple. It's human nature to try and complicate things more than they need to be. So what I want to do is I want to try and press the easy button. Now, it may be that you do and a some silly things from time to time, and add that layer of complexity into an unnecessarily complex process. But I think when you can spot it, okay, I'm doing a lot of repetitive tasks. I'm doing a lot of repetition. How can I press the easy button? How can I streamline this? How can I simplify the process? How can I make it better? And I think if you take that curious mind, again, I like the Socratic approach. I like that. What was it? Einstein also said, everything must be made simple. If not simpler. That's what I'm an advocate of, just making things simple so that it's replicatable. And I like the Socratic approach as well. I've got a slide for that somewhere. Let's not worry about it. But I want to make things easy. And the way that I approach it is I have that almost childlike mindset. A guy called Paul Shealy in the States put me onto this turn of phrase. It's probably very common, but this first place that I heard it, and it was just have a childlike curiosity. and ask questions, those why questions, the why, what if it did this? How do we do that? Just have this open mind, and suddenly you get to a simplification process. So that was the route that I took to making my own trading simple and work. And, obviously you reap the benefits of my frustrations and trying to answer my own questions, because we end up 28 years later from the trading point of view with a simple set of rules, an algorithm, if you will, that allows us to quite literally take the stock market in hand, or to task, and make some money from it. Anyway, so as usual, I'm going to overview my number one money-making process. We're going to be dancing around the never be stopped out again process. So we'll come on to that in a moment. But my role here with these open sessions is to give you the right tools, the correct rules, software to assist you, community to support you, and if you'll allow me to be so, a mentor to show you the right way. I never had anyone to ask when I first started out. I had and made every mistake that you could make. Some of them I've made more than once, because sometimes you just need to relearn those lessons. But the bottom line is we want to get real results. We're real traders with real results. And I want to be able to help you emulate the type of success that I've been blessed to have. The first part of that, the big aha for me, was putting layers of definition on what I'm doing. Again, having that curiosity, having that childlike mindset, having that experience of, okay, well, how do we do this? I was reminded of the movie Cocktail with what was the little midget actor, reasonably famous, attempted to put a performance in with Reacher, Tom Cruise. There we go, that's a little fella. Tom Cruise in the movie Cocktail, he gets a job at the bar, the local bar, and he's asked to make a cocktail, but he's just asked for a martini, which is straight out the glass or whatever. It's like, what's in that? He didn't know. It's his first day on the job. He didn't know what he didn't know about cocktails, but he just said, like, well, what's in it? He's asking the person who's asking for a martini what's in it. So that's all we're doing. We're just asking a level of details. I completely fluffed up. That's a humorous metaphor, but there we go. We'll get it next time. Don't worry. So what's all we're going to do? We want to buy the dip. Well, that's great. Buy the dip. It doesn't mean what we think it means. We need to buy a dip in the context of a trend. We need to add a layer of definition. How do we do that? That's what we're going to answer. This is my number one money-making pattern. Buy the dip in the context of a trend. We need to define the trend first before we can look for a dip. It's a simple little thing. Of course, when you point out the obvious, everyone agrees. It's of course. Of course, that's what you do. But no one does it. Everyone tries to buy down days, down movements, down weeks, and thinks that they're buying dips, but they're not looking for the trend first. Now, neither do we want to be flicking through chart after chart like a mindless zombie. We want to be able to zero in on the best opportunities at the right time, the right moments. This happens, or this stops happening rather, as a byproduct of having a layer of definition on what you're doing. When you know exactly what you're doing, when you're doing, why you're doing it, then you stop asking those questions, where's the trade? And you start just going, oh, there it is right there. That's the experience that we want. One of the things that we've removed the need to do to help with this is this triple time frame nonsense. Again, Van Tharp spoke about it, who's not a trader, he's a psychologist. I'd rather talk to real traders who've done it in the trenches. But this trouble time frame nonsense, I know people make this work, but the reality is I'm going to show you literally in a few minutes time that it's nonsense. It's not necessary to make a profitable trading strategy. You can one time frame it. Again, pick a time frame. Daily charts if you want to get paid at the end of the month, 60-minute charts if you want to get paid at the end of the week even, 2-minute charts or 5-minute charts if you want to get paid at the end of the day. You can quite literally apply a similar or variation of the same process that I'll show you shortly, and profit from daily, weekly, and monthly swings. Again, what we're not going to do is we're not going to add thousands of indicators on the charts to try and assist with this. This is a complete nonsense as well. We just need one indicator, one tool, one time frame, and one way to profit, one pattern, one setup. Gimme, fried chicken. I need a Freddie Mercury slide here, don't I? But it's all madness. You don't need the usual bullshit that everyone says. All it's doing is causing you stress, second guessing, sleepless nights, anxiety, palpitations, and all that leads to is a new high score on the blood pressure. And it's all because the lady loves milk tray. The insanity is on today, isn't it? It's all because we're asking a single question of where's the trade. If you're ever asking yourself where's the trade, you're doing it wrong. You are doing it wrong. We're always doing it wrong. I catch myself doing this even to this day. It never goes away. But I think when you can recognize it, that's what's going to separate you from everyone else. where's the trade? I caught myself doing it earlier in the week. Like, where's the trade? I'm looking for a trade on the S&P. Where is it? Well, shit, it's not there. Actively looking for something that isn't there is that where the stock market equivalent of where's Waldo, flicking through chart after chart, trying to find the one. Where's Waldo? That's what we're trying to do. We want to go, there's the little bastard right there. There he is. There's the trade. That's the experience that we're looking for. And that's what having this curious minds, the childlike mindsets, not worrying about all the usual nonsense that people talk about, and creating an algorithm. And it's just a fancy way of saying a series of if this, then that questions. If this thing happens, then take this action. When this, and this happens, then we can place a trade. And I refer to what I do as a production line for a reason. Step 1, step 2, step 3, step 4, place the trade. That's just moving our decisions along a production line. And if we can't move our next decision along the production line, then there's no trade. We want to be able to get to a nice statement of there is the trade. This has happened. So there's nothing left for me to wait for. Place the trade. So that's what we want to do. And that creates certainty, peace of mind, consistent results. You don't care what the market is doing. I don't care that non-farm payrolls happened 45 minutes ago. It's just creating a little bit of a whippy, sorry type price movement. I don't care what the Fed did earlier this week. If anything, it just sped up what was already happening. The down swinging trades are going to profits. Even the bullish trade, we're in a situation where the bearish trades are bearing and the bullish trades are bulling. It's a nice place to be when you're not worried about which way the market's going. You're just trading the setups. Again, ultimately, we get results. And again, we've got all our regulars in today, so you might recognize your face on some of these. We've got nice regular results. Your results are more important than mine. I actually get my results, but it's yours that make me happy and put a smile on my face. Anyway, just to prove that I can do what I practice what I preach, we've got these broker statements are on the charts right there. Again, just to flick through some recent trades. We're going to go through some live ones as well, but they are all there. Again, the S&P strategy. I've been less active on this. There's been a little bit of uncertainty, as I mentioned, so I've been less active on this the last week or 10 days. A couple of small trades here and there, but ultimately we want to profit from big swings in the markets. So with that said, the routine for the one or two people that are new, hello. If you are on YouTube, pop a thumbs up, a little bit of a comment if you are watching. If you want to look at a particular stock, I see you there on YouTube. We are live streaming this, but the type of agenda that we have today is just going to introduce myself. I've just done that, just give an overview of my philosophy. The types of things we're going to talk about. We're going to look at the charts, the markets. We're going to look at the sentiments. We're going to have a little bit of a talking point about never getting stopped out. So just got a few more slides to take that into consideration, and then we'll hit the charts in real time, and ultimately we'll nerd out in just a moment. Again, if I've got the chat boxes on both the Zoom. If you are in the Zoom, hello, I can see you all there. We had a little bit of a delayed start just as I was fluffing up a few of my registration links, but nonetheless, hello if you're on Zoom. So pop a comment, pop a yoo-hoo and a hello in the chat box, and as soon as I see it, I will respond to it. Just making sure I've got the chat box actually. I don't see it there. Oh, there we go. Right, I just had it on the wrong area. Right, let's do it. Let's get into a very quick talking point of never being stopped out ever again. This is my unabashed attempt to convert you over to the dark side. The traditional way of trading, whether it's stocks, futures, forex, crypto, bonds, whatever the thing is that you're trading, traditional way is to buy the underlying assets, to place a physical stop loss, a hard stop loss, a protective stop loss, all different ways of saying the same thing, into the marketplace. Inevitably, we've all seen it. We get stopped out. The royal we, you, me, Dupree, everyone has had the experience of taking a small loss, and then you sit on the sidelines and quite literally wave goodbye to the trade as it does the thing that you expected it to do in the first place. And inevitably, when that happens, that's the one that would have smashed through target and gone to the moon. We've all had it. So one of the things that we get when we think of a different way of placing a trade is I'm going to go from trading stocks. I predominantly trade stocks. We can do this with futures. We can do it with forex. There isn't an optionable derivative, or an option as a derivative of the underlying product. I'm really overcomplicating this already. I trade stocks. Let's stick with stocks. Mostly I trade stocks. ETFs, same process. But what I'm going to do is, instead of trading stock, I'm going to trade the option for the stock. So it's less capital intensive is the first thing. So I can trade multiple stocks and not have the huge capital allocation. You might have 20, 25% of the stock's value. So if you have 100 shares, you're going to have 20, 25% of the underlying, the stock, to be taken by a broker as reserve to carry the position or hold the position open, the margin requirements. And obviously, if you have the full cash account, if you're doing this in a tax efficient account, like depends on where you are in the world, you might have to have the full cash allocation. And that's very capital intensive. You might only be able to trade a couple of positions at any one time. But as soon as we move into the world of options, one of the things that changed in 2009 was the margin requirement is not needed, because as a buyer of the option, your risk is limited to the price of the option. So that same risk allocation moving from stock, let's say you only want to risk $1,000 on the stock, you buy the stock, you've got stop loss that equates to $1,000, and you've got, for example, say 100 shares to represent that risk allocation. Then you've got the margin requirements. It's very capital intensive. As soon as we move to options, the margin requirement disappears. Your capital allocation, your risk allocation is the same thing. It's going to cost you $1,000 in this hypothetical example, and your margin is $1,000. It's exactly the same. So there's no extra money involved. And that means that the capital allocation that we have for a single stock, that can be better used elsewhere. Suddenly we have a lot of available cash to trade multiple stocks. We can trade a portfolio and start competing right next to with the institutions, the banks, the hedge funds, because that's how professionals make money. They're not getting rich off one trade idea. They're getting wealthy off trading a portfolio. It is a portfolio. Hedge funds, banks, institutions, money managers, they have a portfolio that suits their trading style. So that's what I'm doing. I'm doing the equivalence of managing my own portfolio on the bullish side and the bearish side. It's hedged naturally by trading both the upswings and the downswings on a small basket of stocks on a consistent, regular basis. And I use stock options for that. And again, this is why I don't have to worry about what the Fed's doing, what non-farms is doing. We've not looked at it yet. We'll look at it later. I don't care if the market's going up, it's going down. We should be able to make money somewhere along the way in the swings of the stocks or individual stocks, ETFs, the market, whatever the thing that you look at, because we have this portfolio experience. So that is it. So how do I never get stopped out again? So let's take a look very quickly. There's just 3 slides and then we'll move on to the real charts. A couple of slides. The first thing is, if you've not already gathered by now, just change the vehicle that we trade. I'm still going to find the trade in the same way. I'm bullish or bearish on a stock. But instead of buying the stock, I'm going to reserve it with an option. So if options are brand new for you, the simplest way, and I appreciate that for those who do know what options are, it's not entirely accurate, but for the new people who are just coming around to this idea that I've tried to pitch you on, they're like a deposit. Instead of buying the stock, we're going to reserve it with a deposit. Again, just like you would go to a car dealer and you want the particular car on the forecourt, and it's got the right color, the right spec, it's got everything that you want, but you just need some time to sort the paperwork out, sort the insurance, make sure that it's in your finance out, whatever the thing is you need to sort out. But you want to say to the car dealer, I'd like that particular car, not one like it, that particular car. And they're going to say, sure, just leave a 10% deposit. So you leave a 10% deposit, the car dealer say, great, I'll hold it until the end of the month. And if you don't come back at the end of the month, then your reserve, your option to buy it has expired. It happens in the real world all the time. You can do it in real estate, in property. You can reserve houses. You can flip notes. There is a phrase for it. I can't quite think of it. It's off the top of my head. But it happens in many, many times, many areas. And again, it's just like a deposit. We're just going to do the stock market equivalent, which is a stock option. Instead of buying 100 shares, we're going to reserve 100 shares. If the stock performs in the way that we expect and goes up in value, then the value of the option will also go up. Again, let's look at the real world example. If it turned out that Steve McQueen used to own the car while you're investigating, you're making sure it's not a ringer, it's a real car, you're sorting out the insurance, and you discovered that actually Steve McQueen, or insert your favorite famous person, used to own that car, then the value of the car goes up, but you control it at the old price. You've reserved it. You control. It's a legally binding agreement. You reserved it at the regular price. You left a deposit. You control the car. You have agreed to buy that at a cheaper price. But Steve McQueen, a famous person, used to own it. The value of the car has now gone from $20,000 to $1 million overnight. You own the car. You control the car. So you can take delivery of it if you want. So the value of your deposit has a value as well. So it works the same in the market. So you can sell the option to buy the car, the deposit, onto someone else who may want it, because they get the car at a discount and you get a portion of the profits. Or you can take delivery of the car and sell the car at the high value. You've got choices. What we're going to do is I don't want to take delivery of the stock. I'm going to reserve the stock. If the stock goes up and profits are like I expect, I'll get a proportional value assigned to the option and I'll sell my option back to the market. I don't want to ever take delivery of the stocks. That's how we're going to do it. So that is what's going on, the mechanics behind the scene. So how do we never get stopped out? Well, let's look at a quick example. I frequently get asked, what are the choices? Again, when you look at this is what's known as the option chain. The option chain is essentially a giant spreadsheet with all the expiration dates. Just like we said with our car dealer example, I will let you know at the end of the month, 30 days. I'll let you know at the end of the month. We've got all of these expirations available. Now, I want a lot of time on the clock, more time than I'll ever need. I want to avoid what most people would commonly interpret as the Greeks. So I want to default to 150 days. Again, for swing trading, I want to profit at the end of the month in a perfect world. My average time in trade is about 30 to 45 days. And so I want to default to profiting at the end of the month, but I'm going to go out to 150 days as an absolute minimum. It's more time than I'll ever need. It helps me avoid a lot of the variables that come with trading options. Again, we don't remove them completely, but I do get to avoid or sidestep initially a lot of the usual concerns with what most people call the Greeks. They are still there, but they are minimized. So that's what I'm going to do first and foremost. So I'm going to go out to the expiration that is nearest to 150 days. If you're ever worried about, like, should it be, 140 or 160 days, it's always better to have more time. Always have more time. It's better to have more than less. Better to have it and not need it than to need it and not have it. The trap that new traders fall into with options is they have, for example, they think that, let's use our same example. I want to get paid at the end of the month, so I need a 30-day option. Well, you've got 30 days. What if it takes 35 days for the trade to profit? And we've just had this with Amazon, with Google, with a few other stocks where we placed a trade, a swing trade, and it went sideways for 1, 2, 3, 4 weeks. And quite literally the last 5 days, if you've been watching the markets, Google, Amazon, Apple, they've all fell out the tree and done all their profitable move in 3 or 4 days. So if I just purchased a 30-day option because my average time in trade is 30 days, I only need 30 days, so I'm only going to buy 30 days on my option. Well, the trade's a loss, and then you've watched it do the thing that you expect it to do. That's what we're trying to avoid. So it's better to have more time than less time. 2 or 3, even if you want to go more, 4 times more time than you can ever possibly need. It's better to have more than less. Now, the next part of this is because I'm going to never get stopped out, I'm only going to buy an out the money option. So typically I default to the first strike out the money. If you know what that means, great. If you don't know what it means, there's this wonderful thing called Google. Unfortunately, I haven't got time to give you a crash course in options. The Google out there's lots of written resources. Your brokerage will have information, but I'm going to default to the first strike out the money. If I'm bullish, I'm profiting from an upward movement in the stock price, I'm going to buy an out the money, one strike out the money on the call side. If I'm bearish, I'm still going to be a buyer. I'm going to buy a put. I'm going to buy one strike out the money. That's my default. That's what I do. So 150 days to expiration, the first strike out the money. And this is what I like to do. I'm doing that because I've got the least cost, but it starts the benefits the soonest. So again, I'm going to focus on a bullish example. So again, row number 2 here. This for me is the one strike out the money. The stock price next to number 1 there, top left. The current price is, as I took the screenshot, is $365.86. So the first strike out the money is going to be above the current stock price. It's always going to be relative to the points that you look at the chart. So it is constantly changing. So just default to the first strike out the money at the time that you look at your chart. So in this case, the 370 strike is my first strike out the money. It's got the least cost. I'm only buying time, but that means then that I can use the full price of the option as my built-in stop loss. So as I'm looking at the SPY, the options are a little bit pricey. Again, individual stocks are going to have a lower cost. If you want an alternative, SH is an inverted ETF. And again, you can get it for pennies instead of pounds, essentially. Just a different way of doing things. So the price of the option is $23.94 per share. Again, the maximum times by 100. Every option contract has 100 shares, or controls 100 shares rather. And so my maximum risk is $2,394. That's it. If I was to place my trade and the stock collapses, what's the worst that could happen? I lose my deposits. It's the same here. My maximum loss, no matter how wrong I am, the stock, or in this case, SPY, can halve in value. And my risk is fixed on the entry. I've managed my risk on the entry. I've limited my risk on the entry. I'm going to say this 1,000 different ways. I've got fixed risk on the entry. I'm not worried about where a stop loss is. It's built in. That means that I can take it all the way to expiration if I need to see if I can manage it better. I don't plan on doing it, but I've suddenly got a backup plan. I want the trade to last about 30 days. If I'm right, it'll take care of itself. If I'm wrong, I've got 150 days to figure it out. I've got 150 days to manage it back to break even, because we've seen plenty of times where the trade has gone underwater, classically been stopped out. So again, we're going to look at some real examples in a moment. And then it does the thing that you want it to do. We don't want to be practically stopped out. Now, if I'm wrong, think about it. If you're wrong, you're wrong. You're always going to be wrong. It doesn't matter how wrong you are wrong. So why don't we take care of the loss control, to keep your losses tight and in line with your expectations or your personal preferences? You can manage that on the entry. I've done it. I've dealt with it. I never have to worry about it again. The only thing I'm now focused on is how much money am I going to make? If and when I'm right, I can focus on the profitable outcome. So if the stock does go up in this particular case and it, rises, then I get to work out how much profit am I making. So it allows me to focus all my attention on a profitable outcome. Does this make sense, folks? Everyone happy with this? It's a very simple concept. 150 days to expiration, one strike out the money, use the maximum price of the option as your built-in stop loss. So you've dealt with the risk parameters on the entry. Now you can forget about the loss side of the equation. It means that we can focus all our attention on the profitable side of the equation. How do I manage this to a profitable outcome? If it underperforms, I've got a chance at a break-even trade. I've got 150 days to see if I can manage it more effectively. Again, if the trade's going to be performing as we expect, then it will perform as we expect, and we can focus our attention on closing the trade at or close to targets in the next 30 to 45 days. Pretty cool. Everyone happy with this? Let me just check the chats. I don't see any chats, but pretty straightforward. Everyone happy with this? Nice and simples. Simples. Perfect. Everyone's in agreement. Right, let us then go and look at some examples. Let's hit the charts. Hit them charts. Perfect. Cheers, Brett. So, some examples. Some examples. Some examples are Amazon. That's a great example. So Amazon 60-minute charts. You've seen me talking about these trades. We've had a couple of back-to-back trades. Let me just zoom in so we can see this. If you're watching this on with me on Zoom, hello, if you're just stepping in, you should be able to pinch the screen if you're on a mobile, if you've got a small screen. If you're on an iPad, you should also be able to pinch the screen. If you're watching this on the YouTubes, suck it up. Unfortunately, you're just going to have to squint. But if you're on Zoom, you should be able to pinch the screen, zoom in, and see some of the detail. So what I'm showing you, this is Amazon. And again, I'm open about what I'm doing when it's working in these open sessions. If it's not working or underperforming, as I like to phrase, it's not that it was a bad trade. It's not that it was a wrong trade. I'm trying to manage my mindset. It's underperforming. So my trade was here, as I've highlighted on the charts. That was the one you've seen me go through this trade, and it's been meandering sideways. The last couple of weeks, I've been saying, if I can get this, manage this better, I will. But you can see the trade was on, and it goes against you straight, or against me straight away. Now, whether you're choosing a traditional stop loss, you're using a percentage of the stock as price, usually, a couple of percentage points, 1 to 3% is pretty standard. If you're using 30 to 50% of the stock option as your risk control, at some point here, you would have a 30 to 50% loss on the option. So if you're using physical stop losses on the stock, or even if you're still trading with options, but using the stop loss, then at some point here, you will have closed the trade. Maybe you took a re-entry as it moved back in your favor, but then it's got same thing again, that 1 to 3% on the stock, the percentage loss on the option has been hit because you don't want to lose any more money. You close the trade, and then what happens next? Gap drop, gap drop, gap drop. Holy shit, it goes from showing you 70, 80% of the premium is being lost on the option to holy shit, we've smashed the fucking targets. I've seen this happen so many times over the years. There is zero benefits to closing the trade early. This is a great example of why I'm using 100% of the option premium as my built-in risk control. It doesn't matter how bad things get. My risk is fixed to the price of the option. I'm not ever going to get stopped out ever again. I'll still have losses. Don't mistake what I'm saying. I'll still have losses, but I will never be stopped out. I will always be early to a trade, but I will never be late to the party. I'll always be early and I'll never be late. And this is a great example. Is it the only one, Phil? No, it's not. This is just one that went from mostly losing. I was in my mind, I was writing it off. I was just waiting for my opportunity to do something with it. And then wallop, plenty of time to sort things out. Guess what? Baidu did this. Well, Google's doing the same thing. Look at this bad boy. Look at this sucker. Now, this same thing here. Price was on and then going sideways. Didn't get to target here. So I've closed this out for this particular one for a small profits. I've got a new entry here. Same thing, sideways, sideways, sideways. At this point here, it's rallying before its earnings. I'm around about 80% of the maximum potential loss. In my mind, I'm writing it off. I'm just waiting for expiration. If I can get out at a better price, I will. Gap drop, gap drop, gap drop. You couldn't have asked for a better outcome. It worked, went from mostly losing to, well, holy shit, we've got a great target opportunity. I'm probably going to close this today, in fairness, and put some cash in the coffers. We've already spoken about Baidu. Baidu's doing this as well. Or Baidu did this as well. Now, here's two. We've got one that is done the same thing, but we've gone from there, initially going against you. Trade on, just about there. Initially going wrong. Again, I'm always going to be early. I'm never going to be late. I don't know that that's going to happen. It's just the way that it worked. We sat through a little bit of retracement, and then it's gap drop, gap drop, gap drop, gap, and then wallop, smashes targets. Thank you very much. Now, in this particular one, I'm in a trade. It's going sideways. Again, traditionally, the algo that I've got firing off here, the algo that I use to validate all the stocks that I trade, technically it's been stopped out. And just because it uses stock to work out all the performance calculations, let me just click go on the strategy. There we go. So this is what I'm on about. So the strategy that I use, I've covered it many, many times. I'll forego going through it this week, go and revisit some of the old recordings. Again, I've gone through the strategy many, many, many times. But if we just bought the dip and sold the rallies, as I've described many times in the past, then we've got a nice positive equity curve. So this is why I'm trading it. It's a consistent performer, but it's consistently performing with stock. I need to put a stop loss in to be able to put the parameters in. So just by moving away from a more traditional stop loss, again, the algo technically has lost money, but it's just going sideways. It's gapped up a little bit. I still got the opportunity. I've got plenty of time on the clock, more time than I'll ever need. Firstly, to see if I can manage it more effectively. That's code for if I can get out at break even or better, great. But because there's only been a few days since this last trade on, it's been less than 5 days has gone. I've got lots of time. So if this starts to resume the trend like it did over here, I've got plenty of time. I'm still inside that window of opportunity that I'm expecting my trades to perform on average, but this one's underperforming for the moment, but I've got time to figure it out. I've even got time to see if I can actually turn it to a profit, and it does the thing that I was expecting it to do in the first place. So again, I'm just trying to show contrast. Here's one that's not quite working the way that we planned. George, bear with me. I've got the postman knocking at the door. Please talk amongst yourselves while I go and run to the door. Hello, hello, and we're back. Well, it's the real world, isn't it? Things happen from time to time. Right, so where were we? Oh yeah, I was just trying to illustrate that, hey, it doesn't always work to plan. It doesn't always work to plan. So what I'm trying to ultimately do is that hopefully illustrate that there's lots of benefits that are not obvious when we just simply move from stock to a stock option. Again, this is a great ancillary benefit. And I've got to admit, when I first started trading options, it wasn't clear that that was a good benefit. And the longer I've been doing this, the more time I like to have in the back pocket, for want of a better description. The more time that there is, it always works out nicer. Let me find one that didn't go from max loss to target. I'm trying to remember, was it IRSG or, just bear with me. Trying to remember. Was it MCO? Was it that one? Yeah, MCO, I think it was. Again, just going through, I just want to go through some of the less, rather than just always show the headline stocks. I think it was ISRG now I'm talking about it. Yes, anyway, so here's one that didn't quite work out as planned. So for example, trade on here, sell the rally. Again, just tickled me in the trade and then does that. Now, it doesn't, again, if you think about it, I mean, this has gone from 270 to 320. So 270 to 320-ish, give or take. So there's a, $50 against me. Now, because I'm using the full price of the option premium, I don't need to worry about how wrong I am. Again, when you're wrong, you're always wrong. It doesn't matter how wrong you are, but the risk is fixed. Again, just using the hypothetical example, if I just want to set my risk to $1,000, 100, 5,000, insert a number. The number doesn't matter, it's just a hypothetical. But if I want to limit my risk to $1,000, this can go $100 against me. It's still only going to be $1,000 risk. It doesn't matter how bad things get. When you're wrong, you're always wrong. But we fixed our risk to $1,000. So what benefit is there to closing the trade up here by having an artificial stop loss? Why don't I just use the full price of the premium? And I get the chance to manage it better. So prices rallied. Here's my entry right there. Prices sold off. And at some point, it was around about here, I think. Price comes back to, well, in this case, I've got a little better than break even. I think we went through this. Let me just get my handy dandy slide. I did a little bit better than break even. Here's the broker statements, just so you can see that I'm not Billy bullshitting you. But there's the trade, the entry. It does move, does the thing that I expected it to in the first place. But you know what? On this occasion, there's the broker statements. There's a small gain on this case. This is what I refer to as a break-even trade. It took too long, but I got to manage it more effectively. It's timed out. And essentially it's a break-even trade. But most importantly, I've avoided the loss simply by moving from stock to a stock option. And this is one of the wonderful ancillary benefits that we get just by, okay, let's not have huge position size. Let's reduce the position size, use the full price, the premium, and we get this wonderful side benefits. And if we just stop thinking about looking at how much money can I make if I'm right, well, let's think about how can I minimize the losses? This is how professionals do it. This is how people do, and there's lots of ways of minimizing the losses, but it's just hopefully just some good examples of how do we not be kicked in the shins when we're wrong, and how do we maximize the gains when we're right? And even when we're wrong, we can be right. So here's a good example of when we're wrong, we're still right. Again, it wasn't a headliner like one of the ones I was just showing you, but it just allows me to manage the trade more effectively. That's the fancy way of saying try and figure it out before expiration. And this is a great example. And now it's setting up a gain. But I think we can all agree that look at it this way. Look at it another way. If you'd taken the trade, stopped out, you maybe, let's follow the algo. You got 1 in, 2 in. Oop, my connection's just a little bit ropey. So you got 1 trade on there, 2 trades on there. So you got taken 1 loss, 2 loss. You've got a trade on there. So maybe you've taken 1 trade or 2 trades there. So you got 1 trade, 2 trade, and maybe that trade just gets you the break-even trade. So overall, you might be, break even. Maybe there's a slight profit with the 2 trades. Again, just looking at the algos, it's been in and stopped out, in and stopped out. So just on these 3 trades here, and there's a brand new one's just fired off. But just on these 3 trades here, maybe there's a break even, maybe there's a small profits, but you've got in, stopped out, in, stopped out. Would you have taken that 3rd trade? Because the last 2 got you stopped out. And if you've not got access to a proven strategy, you've not got the algo that at the click of a button you can validate and prove that the strategy is profitable and works for you, then you have this uncertainty. So would anyone have taken that? Because you've got this recency bias that gets you stopped out. By moving from stock to stock option, then you avoid being stopped out there. You only take the profitable trade if or when it happens. I think this is a wonderful place to be. Sorry, hopefully I know all the regulars are sold on this, but for any of you watching on the YouTubes who've not seen this before, just let me know. Does this make sense? Shoot a comment in the chat box. If I don't see it straight away, I'll get to it later. But does this make sense? This is just one of the wonderful benefits of just shifting from the old way and trying a slightly different way, a new way. Perhaps it's a better way, a more efficient way of doing the same thing without ever worrying about being stopped out ever again. So some great examples. I think ISRG was also ISRG. Oops, a daisy, pressing all the wrong buttons here. ISRG. This was another one that recently wasn't working the way that I was planning. ISRG, come on. ISRG, come on, TradeStation, you oversensitive bugger. Yes, sorry, there we go. So another one, and just highlighting again, not headliner, it's just one that wasn't working the way that we planned. Again, sell the rally in a downtrend, rallies, again, gets back at a break even. Again, you've got the opportunity to manage it more effectively somewhere around here. Again, I can't remember, I've got the slide, I've shown you it previously, you've seen the broker statements before for any of the regulars, but you avoid the unnecessary in and stopped out, in and stopped out, in and stopped outs, because you're not being stopped out in the traditional way. You still have losses, you still be stopped out, but they get deferred until expiration. It's a wonderful place to be. It's quite liberating. When all my students kind of apply this approach, the first expiration cycle is always the most nervous, because it's a very different way of doing things. Your losses get deferred until expiration, so you'll still have them. I'm not saying you won't, but you've given yourself a fair crack of the whip to manage them better. And you'll manage, let's just say that you've got 10 trades, just random number picked out the air, that are underperforming. They're not doing what we expected them to do. And maybe you get a chance to manage 3 or 4 of them more effectively. Instead of taking the 10 stop losses that you would have done traditionally with a physical stop loss, you're just deferring that decision. And maybe you can manage 3 or 4 of them more effectively. So, okay, it's not going to be all of them, but maybe 3 or 4 of them you can. And I think that's just a wonderful place to be, that you get to apply this corrective action on the ones that are not working, and they were never going to work. We don't know, without any benefit of hindsight, we don't know which ones are going to work, but we get to do something about it if they, at least temporarily, just give us a little bit of favoritism to say, okay, I'm briefly in your favor, like this one here. You can have a break-even trade if you're quick enough. And again, if you're quick enough, might be several days or a couple of weeks. So there's plenty of time to sort these things out. This is the daily chart, remember. So there's always a bright side is what I'm getting to. Always look on the bright side of life. Absolutely, yeah. Brett's just commenting, taking the trade is each and every time is part of the philosophy. And yes, it is part of the disciplined trader. But I suppose one of the other benefits here, again, if you took that trade, traditionally you would have been stopped out there, but you don't need to take the new trade, which would subsequently have been stopped out. And you don't need to take that trade because you're already in and you've used it to manage the trade more effectively. So this is what I mean by when you move to options, you're not being stopped out. You don't have to worry about re-entries. And the trade that turned out to be profitable anyway is your opportunity to manage this one that's not working. So it's just a better place to be. It's a far better place to be. I know I'm preaching to the converted for everyone in Zoom here. We're all convertees. Right, let's finish on market breadth. One of the things that we've introduced in the last 3 or 4 months is this indication of market breadth. Or sentiment. I prefer to refer to it as sentiment, actually. And all this wiggly line at the bottom here. Yeah, or Brett's question. Anyone who's got a question, ask a question. If I've missed it, just retype it. But this particular tool at the bottom, it's not an indicator. It's actually the number of stocks that are above or below the 20-period moving average. That's it. It's available on most platforms. It's available on most platforms. And what it's allowed me to do is just see if the markets as a whole, the market breadth, is rallying or selling off. And one of the things that you'll note, if I just, where's my line? So I'll answer your question in a moment, Brett. If I just look at the bullish extremes here, bullish extremes. So price is at a bullish extreme. And what that means is that the number of stocks that is above the 20-period moving average represents, and again, the two red lines here, represents between 80 and 90%. So 80 to 90% of the stocks at this point were above the 20-period moving average. And the sentiment shift is I'm expecting or anticipating a move in the opposite direction for it to go from one extreme to the next. The number of stocks down here then, between the two blue lines, is 80 to 90% of stocks on the S&P 500. So about 450 stocks of the 500 are now below the 20-period moving average. Okay, there's nothing magical about this. But what happened next is we saw a market rally. Now, we didn't get to an extreme there, but we got back to the lows here. So we expected a rally. A rally happened. And what we've noticed is there's a lead time of around 7 to 10 days before we can see price shift in direction, the sentiment to change. Again, we've got this one here at an extreme there, and then what we see is price sells off. We get the extreme here, we see a market rally. Now, this one wasn't a huge rally, but in that small rally, we got to here where all of the 450 stocks are above the 20-period moving average. And what we saw is the famous whiskey shorts. Phil was on holiday, supping a few whiskeys, shorting the market. And it was awesome. The one that kind of caught me, and this is where we started to look at this sentiment shift. And we've got bearish indication there, price rallied. But here, if I just mark it off, it continued to be at an extreme for a long period of time. So I've got to admit, this caught me on the back foot, but it stayed overbought. I'm just going to slap myself on the wrist, folks. I hate that phrase. Overextended is the phrase that I want to say. It went to an overextended market reading. Again, I do believe there's no such thing as overbought, oversold. I'm going to officially write out 100 lines to say, it's bullshit, because that's what I normally task all my students with. Anyway, I'm laughing at my own frivolousness. But we get the sentiment reading, what happened, price sells off. We get the bearish extreme. The market is down here. We see the market rally. That's what we've been talking about the last couple of weeks. Now we've got the opposite sentiment indication. And guess what we've been doing? Guess what we've been seeing? Is it any wonder that the market's selling off? Now, it may rally again. We're expecting the markets to shift based on our cyclical analysis. We looked at that 2 weeks ago. Please feel free to go and look at the replay on the YouTube where we talk about cycles. 8th of November is the dates in our diary. Post midterms, we've got lots of cyclical analysis. Post midterm, end of year, individual stocks, seasonality, yada, yada, yada. We can stack them all together and we're expecting a market rally. Hopefully in the next couple of days, we'll be down here. We'll have a bearish sentiment extreme. That would be a wonderful situation, or at least if we can get to that 50% mark before we see price push to the upside. Again, we're already targeting 4,200 post midterms. So this sell-off is hopefully just in anticipation of that market rise. So it's going to be good times ahead. And to be fair, whatever happens, it's just a little bit of sentiment analysis tied in with a little bit of discretionary opinions. It doesn't really matter what happens, because guess what? We've got a number of bullish trades, we've got a number of bearish trades. It doesn't really matter whether we're right or wrong anymore. We're just going to profit from the swing as and when they happen. But we're expecting a reasonably good move post midterms. We'll bias the bullish side on the viewpoints, but the portfolio has a number of bullish trades. It's got a number of bearish trades, as you've seen, and it doesn't really matter which way the market goes. But that's how we're reading sentiments for the moment. Question from Brett. Good question. What about using open interest for sentiment? Open interest in the is one of the metrics that you can look at in options. I don't. One of the things with volume, and again, it's a variation of volume. The number of contracts that are available to trade is open interest at any particular strike on the options. I know some people do, but one of the things, I don't know if you've noticed, Brett, but I have actually removed volume off all my charts. I used to have it on. I did nothing with it. It served no purpose. It was just for filling some space, if I'm going to be honest. There was no particular rhyme or reason as to why it was on my chart. So I removed it. I don't pay any attention to volume in any form for that matter. Similarly, open interest. Again, it doesn't mean that there's no value in it. It's just I've not figured out a mechanical way to interpret it. And that's the key point there, a mechanical way to interpret. I'd love to. I know that volume can be a nice addition, but I've seen low volume rallies. I've seen high volume rallies. I've seen volume spikes on breakouts. I've seen low volume breakouts. There's no consistency with the interpretation as far as I'm concerned. There's no consistency in the interpretation. And again, insert volume, insert open interest. There is some value in it, but it's such discretionary in its interpretation. I tend not to bother, Brett. I've tried over the years. Where the benefit of my early part of my career, I spent 12 years predominantly just trading Forex, and there's no volume on Forex. I mean, there is volume, but there's no accurate volume. So I just got used to trading without volume. So it was never a skill that I paid any attention to for a long time, and I just learned how to trade without it. So yeah, exactly. It's a flavor of spice. You can sprinkle it on afterwards. Find the trade first, as we always say, and if you get some value at it, then go for it. We had a similar question. I'm trying to think who was asking about it in one of our private calls. Similar question. What about volume, essentially? And if you are going to go down that route, the only thing that if I could be bothered researching it, I'm too long in the tooth now, I would look at volume profile. Volume profile. I know traders who do very well with it, and instead of looking at volume on individual days across the bottom, you're looking at the volume at price levels. So maybe there's a huge volume spike at this level here. That might tell you that this is an important location because there was a lot of volume at a price point. I think that's more important than volume at a time. Because maybe you've not got a lot of volume there on that day, but there was a lot of volume here, over there. But price is not really doing anything with it, or price is, at this particular point here, collectively, at this point, this point, this point, this point, there was a lot of volume traded. So that's telling you that there's a lot of interest at that point. But on the individual days, there's not that much volume. So if you are going to go down the volume route, take a look at volume profile. There is some value in it. I've just not had the bandwidth to commit to study and research on it. But what I have seen, it looks like it could be useful. Absolutely, yeah. The points of control, the pocket, whatever it's called, yeah, it can act like a magnet. But if you think about it, the reason why there's huge volume at these levels, not on any one particular day, it's spread over days, weeks, maybe even months. That's the institutionals filling the boots or, unloading the cart. That'd be one way of interpreting it. That's the kind of the base logic behind looking at price levels for volume. Anyway, it can be useful, so worth considering if you want to. Again, I haven't got the bandwidth for it, to be honest. Again, I mean, what we're doing is working. If it ain't broke, don't fix it, as I keep saying. But yes, if you're going to do it, that'll be a good addition if you want to go down that discretionary route. Absolutely, yeah, absolutely. Right, chaps and chapesses, I think that we've done chasing squirrels. We've reviewed my ever-present pitch to convert you to the dark side of stock options and to do it in a smart way. Smart traders are all about keeping your losses to a minimum, cut your losses short and run your profits. Well, we can cut our losses short on the entry and never think about them again. We don't have to worry about, did we place the stop at the right place, blah, 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 yada, yada, all the other bullshit that goes along with it. And we'll never be stopped out again. So if there is a huge move, like PayPal, for example, I've just noticed PayPal's gapping, gappy. Where are we? PayPal. Oh, I've not got a short-term swing on it. I have got a trade on PayPal. PYPL. Got a daily swing on this. So PayPal is, gappy. The algo is just fired off. 1, 2, 3 weeks early, and then gap move. It's nice to be on these trades without worrying about if you've got the entry where the stop loss is. Again, you're not worried about these things. So again, I'm just catching myself repitching you the concept of options, but it's just a wonderful place to be when you're not worried about the exit if you're wrong, and you're only focused on the exits if you're right. It's a far better place to live. Anyway, with that said, where's my, I've got a thing. So new podcast. I've done 2 this week. If you are and want to get a double dose or even a triple dose of what I'm up to without having to wait for these Friday sessions. Again, I'm trying to be semi-regular once and occasionally, or mostly twice a week. We've got a nice little back catalogue building on the podcast. Just feel free to search AntiVestor in your favorite podcast player and it should pop up for you. You can click the links in any of the emails that you get from me, and there should be some direct links to Spotify or YouTube. And again, if you use different platforms, just feel free to search AntiVestor in your favorite podcast player. If you would like to go further, faster, and maybe a little bit deeper, suits you, sir, and get to your trading success a little bit faster without trying to Frankenstein a system together from free stuff or textbooks, and you want to know what to strip out, if you want to know what to strip out so that you can progress along your journey just a little bit faster, you are invited to work with me. I don't work with everyone. I turn many people away just because I've got the luxury of being able to start. I'm a trader first and educator second. And if you've got a toxic mindset, then I probably don't want to work with you. So if you have a toxic mindset, don't bother getting in touch. If you really want to get there faster and you want to learn a process that works, that gets results, and more importantly, that you can emulate the type of success that you see me talk about every week, then feel free to get in touch with me. The same results that, Kyle, Colin, Stephen, John, Stewart, Randy, obviously Bal, all the regulars that are here, you are invited to apply. Just follow the links on my websites, fill out a quick assessment form, and we'll take it from there. I'll be notified and I will be in touch. Quick thought though, if you are new to thank you, Brett. Brett's just saying I'm a great instructor. 2 quick thoughts though, before we do sign off. You can continue to do it the old way. There's nothing wrong with it. I did it this way. I did it the hard way. And it probably added a decade onto where I am today. But then on one hand, I wouldn't have been here today saying that there's an easy way. you can do it the hard way or you can do it the easy way. Again, I did it this way. I did it by learning from mistakes, Frankensteining things together, and eventually you come to a profitable trading system if you can stick at it long enough. But that was the choice that I made. You can keep flapping around, Frankenstein something together, or you can do it the fast way. You can plug into someone else's hard work. You don't have to spend, the first, 10, 15 years of your life trying to fit, or your trading career, trying to figure it out on your own. You can press the easy button. You can plug into someone else's system. I don't mind if it's my system or someone else's system, but plug into something that's proven to work. If you need help and you like the sound of what I'm doing, then send me a message. I don't know if what I do is right for you. I'll always have a chat with every serious trader. And if it's not right for you, that's cool as well. I'll always point you off in the right direction and help you avoid some of the landmines and pitfalls that are out there as a new trader looking for their system. But if my system sounds good for you, then get in touch. And again, if it's not for you, that's cool as well. Again, I don't mind either way. I just want to make sure that every trader is on the right track for them. So that's it. Get in touch if you want to. If you don't, that's cool as well. But what's that saying? The best time to plant a tree was 20 years ago. Second best time is today. Right, I think that's it. Let's do it. Let's where is it? Where is it? There we go. Let's do it. Final words, as always, a little bit of appreciation. We could all be doing other things with our time. Thank you so much for taking a moment out of your day to spend it with me. It really does mean the world when everyone is chatting and interacting and gets involved. Thank you for all the comments in the Zoom. I'm not seeing them on the YouTube. I know they're there. I just think I've logged in incorrectly, but I can see that something there. I will respond as soon as I get to them. But nonetheless, thank you all from the bottom of my heart. Have a wonderful weekend, each and every one of you. Make sure that ice cream is involved in your future. But for now, let's land the plane and call it a session. Have a wonderful weekend, folks. I'll speak to you all at the same time next time. And until then, toodaloo trader.